If we look at the US economy over the past 3 decades, we see a seemingly simple picture: steady GDP growth, the expansion of big tech companies, and the rise of financial markets. But when we put the data together more closely, a less obvious pattern emerges, one that is more about monetary movement than monetary growth. Between 1990 and today, US GDP has nearly doubled, but this growth has not been reflected evenly in people's economic experiences. For example, Federal Reserve data show that labor's share of the economy's total income has remained relatively flat, while corporate profits have steadily increased over the same period. This change may seem small, but on the scale of a $25 trillion economy, it represents hundreds of billions of dollars a year being shifted from one group to another. Over the same period, asset markets have behaved quite differently. The S&P 500 has grown by about 8 to 10% annually over the long term, while real wage growth has been limited to about 1% or less for many income deciles. This difference, compounded over 20 years, creates a gap that cannot be closed by higher income alone, but requires asset ownership. But more importantly, this growth has not been distributed evenly. According to wealth distribution data in the United States, the top 10% of society owns a very large portion of the stock market, and a significant portion of the wealth growth is effectively confined to this group. So when markets grow, the effect is not uniform across society. Some benefit directly and others only observe it from a distance. Alongside these fiscal changes, there has been a geographical shift that is often overlooked. Economic growth is no longer as evenly spread across the country as it used to be. Data on job migration and income growth show that much of the new growth has been concentrated in a few economic centers, cities like New York, San Francisco, Austin, and a few other tech hubs. In contrast, many medium-sized or small areas have experienced much slower or near zero real income growth. This means that the economy has moved from a diffuse state to a concentrated state. And perhaps most importantly, in such an economy, the main issue is no longer just the amount of income, but one's position in relation to the main flows of money. Where one is in this structure determines, more than any other factor, whether one benefits from economic growth, or merely watches it from the sidelines. This is where many people experience a paradox: the economy is growing, but personal financial well-being is getting tighter. The reason for this paradox, in its simplest form, is that income and spending are not moving at the same pace. Necessary spending has grown faster, while real income has increased much more slowly. In such a structure, the economy has gradually shifted from an income-based model to an asset-based model. In the past, economic growth meant mainly rising wages and job opportunities, but in today's economy, a large part of wealth growth occurs through the appreciation of existing assets, not through the generation of new income. Simply put, wealth is created more through owning than through working. Federal Reserve data show that a significant portion of the wealth increase over the past decade has come not from new savings or income, but from appreciation in the value of existing assets. This means that those who have already entered the asset market are structurally in a different position than those who depend solely on income. Putting this together, the result is a slow but profound shift. Money in America has not disappeared, but has shifted in its direction, from labor to capital, from daily income to assets, and from widespread distribution to concentration. These changes have not happened suddenly. They have accumulated over decades. And perhaps most importantly, in such an economy, the real issue is no longer just the amount of income, but one's position relative to the main streams of money. Where one stands in this structure determines, more than any other factor, whether one benefits from economic growth, or merely watches it from the sidelines. For those with little capital, perhaps the most important and logical asset in the American economy is the index funds that buy the entire market. Many professional investors believe that for most people, investing regularly in funds that track the S&P 500 index is the best place to start. The reason is simple: these funds essentially give you ownership of some of the largest companies in America, and throughout history, the American stock market has been on an upward trend despite crises, wars, recessions, and economic shocks. If someone allocates a fixed amount of money each month to such funds, the effect of compound interest over time can be very powerful. But as an investor gains a little more experience and capital, the issue of choosing the industries that will win in the future arises. One area that has attracted a lot of attention in recent years is the American defense industry. Rising geopolitical tensions, the war in Ukraine, competition with China, and conflicts in the Middle East have led the US government to pay special attention to rebuilding and increasing its missile and defense stockpiles. When the defense budget increases, not all companies benefit equally. A significant part of the new spending goes to companies that produce interceptors, defense systems, radars, and missile defense equipment. In such circumstances, companies like RTX and Lockheed Martin are usually in the center of attention of investors. The reason for this is that many of the interceptors used in the defense systems of the US and its allies are produced by these companies, and each new multi-billion-dollar contract can mean an increase in their income and profits in the coming years. Large investors usually look at the production capacity, registered orders, and long-term contracts of these companies, rather than focusing on daily news of wars. However, perhaps the most important investment topic of the decade is artificial intelligence. Almost everyone agrees that AI is an important technology, but there is disagreement about the current valuation of the companies involved. Some believe that we are in the midst of a bubble similar to the dot-com bubble of 2000, while others believe that we are still at the beginning of a huge economic transformation. To better understand the situation, we can use a simple analogy. Imagine a huge gold mine has been discovered. Everyone knows that there is gold inside the mine, but it is not yet clear which companies will ultimately profit the most from extracting it. In such a situation, the first winners are usually those who sell shovels, picks, and mining equipment, not necessarily those who are looking for gold themselves. In the world of artificial intelligence, many investors apply the same logic. Rather than trying to guess which AI software or model will win in the future, they focus on the companies that provide the infrastructure for the entire industry. The most prominent example of this approach right now is NVIDIA. Almost all AI companies need powerful chips to train their models. NVIDIA has become a major supplier in this market. Along with it, companies like Advanced Micro Devices and Broadcom also play important roles in various parts of the supply chain. Some analysts believe that even if some AI companies fail, infrastructure providers will still benefit from the growth of the entire industry, just like tool vendors during the gold rush. However, the smart investor should be aware that even the best economic stories can be overvalued at times. The history of financial markets has shown that disruptive technologies are often accompanied by periods of over-optimism. The internet changed the world, but many internet stocks crashed in 2000. So too may AI eventually transform the economy, but some companies, or even the entire market, may be overvalued at times. For larger investments, many experts recommend a mix of assets, some in US-based index funds, some in strategic industries like defense and AI infrastructure, and, if you can afford it, some in real estate. The reason for this diversity is that no one can predict the future with certainty. Successful investing in America is not usually the result of a magical decision, but rather the result of consistently owning assets that benefit over the long term from economic growth, technological innovation, and productivity gains. Ultimately, the most important lesson of the American economy is that lasting wealth usually comes from converting income into assets. Many people focus all their attention on increasing their salaries, while wealthier people tend to focus on increasing the number and quality of their assets. Salaries cover the cost of living, but it is assets that work for their owners over time, growing and creating wealth.